So last week we were talking correction, then 2 days in a row Wall Street was up and we're up. So what happened to that correction? One guy who I'm sure has a pretty firm view on what happened to it is Michael Knox, Chief Economist at Morgans. Thanks for joining us, mate. Have we got you there, Michael? Okay.
My question is, how is Adelaide?
Fantastic, mate. Very hot, but it's certainly interesting, I guess, that they've already had their car problems in Adelaide. Before I talk to you about the correction issue, Mike, because I'm going to get you to give us your views on what's going to happen to the economy this year, 2014, the closure of Toyota, or the leaving of Australia, of Ford, Holden, now Toyota, do you think it'll have an economic impact this year, or is it something that's going to be better down later on down the track?
Well, we know the closures are going to be in future years, but when we look at what's actually driving these closures, it's all about economies of scale. You have to get production of a vehicle to between 200 and 300,000 units. And gee, there ain't nothing we make in Australia that we produce up to between 200,000 and 300,000 units of. So Australia no longer can achieve the economies of scale that are necessary to have a car industry. Lots of other things we can do really well. We just can't do this, so we better do something else, Peter.
So do you think that even though it's terrible for the businesses and workers involved, that down the track the reallocation of resources out of an inefficient car industry that just can't get the economies of scale will have long-run beneficial impacts on the economy?
As we know, we already know that more people are employed in Australia servicing cars than building them. Many more, in fact. So if we do away with protection entirely, we'll have more cars imported, more cars being serviced, and in fact we'll have more jobs from servicing those cars than we lost through stopping manufacturing them. So in terms of employment, there is only upside from this. I know that's a terrible thing to say for the people who are working in the plants, and the Australian economy will do other things that we do better than making motor vehicles in numbers that are not big enough to achieve economies of scale.
Okay, mate. Now let's go to the subject I wanted you to talk about. Like last week, there's a fair bit of angst around that, and I was talking about, is this the overdue correction? And it looked like we're heading that direction. Now all of a sudden the Yanks get a reasonably unimpressive jobs number, and up goes Wall Street again. And it went up the day before that as well, and we're going up 2 days in a row. So here's the question: what happened to the correction?
I think it's still out there, Peter. I think it's still out there. Remember, what's just happened this week is that we've gone over the debt ceiling. I think the kind of theatre that we could experience is later this week the House of Representatives is going to pass a bill to lift the debt ceiling, which will include something like, gee, approving the Keystone Pipeline. They're going to send it up to the Senate, and the Senate's going to kill it. And that is when the market's going to get scared again. To me, even though we've had this wonderful bounce in the last couple of days, to me the market still needs to do a little bit more work. Now, and I say that because of how we got into this sell-off. What happened is, you and I remember it well, we were talking about Santa Claus, and we were talking about how Santa Claus was going to take the market up in December. And what happened, Santa did arrive and he took the market up with his reindeer, and it reached a point where, based on our model of the S&P 500, it was a good 100 points too high, as opposed to a fair value of about 1680. Gee, it was 100 points or touch over above that, and at that point we gave it about a 68% chance of coming down, which it has done. Now we've had a reasonable earnings season, and we think that lifts fair value for the S&P 500 up to about 1735, 1736, and on one day in the sell-off we've just gone down and touched that. Really, it would normally need to do a little bit more work. It would need to go either back and retest that level, or it would need to go a little bit lower. So I think it's wonderful that we've had the bounce, but I think we're going to have another retest in the next week or so, and I think the US Congress is going to have a lot to do with that in not being able to pass the debt ceiling just when everybody is convinced they will.
Okay, so do you think a correction, and it's a cliche that's used a lot, Michael, do you think a correction after a big run-up can be a healthy thing for reigniting the market later in the year?
Well, in theory, it's all about price discovery and market clearing. There's a whole bunch of boring economics that's been written about this, Peter.
Yes, I'm sure you've read it,
I think it needs to do a little bit more work, and I think, but later in the year, gee, market fundamentals are improving all the time. I heard somebody earlier saying that he thought the US economy is in bad shape. Gee, I'm about to lift my growth estimate for this year to over 3% because the numbers are looking so good. You are going to get above trend growth this year, and you're probably going to get above trend growth next year, and that means that we're now moving into the best growth period since the US economy has seen since before 2007. You're going to get plenty of earnings growth in the second half of this year. Fair value will rise to at least 1885 is where our model takes it. So you've got plenty of upside in the market, in our own domestic market, plenty of earnings to take it up to near 5,800. So yeah, I mean, this is a very healthy market clearing process. When we have sell-offs, it generates price discoveries. It also discovers the people who can take a hit, and that I think will, as we go through this process, and a little bit more of this process to work through, we're going to be setting up really well for a rally in April and a rally later in the year. But I just think not quite yet. You know, maybe just let's get through this, get this debt ceiling actually passed. Then we can be sure we're going to have a rally, Peter.
Okay, so Michael, you've got a fantastically optimistic scenario. You know, that doesn't disappoint me. I'd be quite prepared to accept a negative scenario if that was what your crystal ball was telling you, or more importantly, your computer models. But what are the things, like, for example, are you worried about the emerging economies issue? Because the gentleman you were talking about on Janine's program, he does tend to be rather negative about many of those things. So I wasn't surprised to hear him being sceptical about the USA. But, okay, you're very positive on the USA's outlook. But what about emerging economies? How do you handle what you're seeing right now?
I think what you've got is a relative twin deficits problem. Those of us who talk fluent nerdish and sometimes talk economics at the same time know what twin deficits are. That if you have a budget deficit, that tends to generate a current account deficit. And you've got a whole bunch of countries, like India is a good example, hey? It's been running average budget deficits of about 8% of GDP. And as a result of that, and it's been doing this year after year, and as a result of that, it has a persistent current account deficit. Well, that's okay in relative terms when the biggest country in the world, the United States, is running a budget deficit as it was in 2009 of close to 11% of GDP. If the US is running a budget deficit of 11% of GDP and India is running a budget deficit of 8% of GDP, that makes India look really prudent and really conservative, and they get lots of capital inflow because of all of the US dollars that are being printed in the US budget deficit, and they look really prudent and they look really smart. And you can use that same story for Brazil. and you can use a similar story for South Africa, and that's really the emerging markets story. But then what happens is 5 years later, last year, the US budget deficit falls to 4% of GDP. Well, if you're still running a budget deficit of 8% of GDP like India is, then you're in real trouble because you've got a structural problem that you've done nothing about. So a budget deficit of 8% of GDP is okay if the US is running a much bigger one, but when the US is running a budget deficit which is half yours, you're in real trouble. So it is a relative twin deficits problem. Will these countries improve their budget deficits and therefore defend their economies? Oh, well, India has a guy who I think is one of the best central bankers in the world, Raghu Rajan. He's been talking publicly about the need to reduce budget deficits. He's got the right information. Is that what they're going to do? Well, you have to find out. But that's really the issue. Relative budget deficits, what they could get away with 5 years ago, they can't get away with now, and that's why their currencies are under pressure and will continue to be under pressure until they do something about their domestic financing policies.
Okay. Well, Michael, we're running out of time, but I guess the bottom line for me is you're not seeing what's going on in emerging economies derailing your economic optimism on the US and our stock market.
We lived through this before in 1997, and what was amazing was the minimum impact it had on the Australian and the US economies. So, no, we've been through this before, Peter. It didn't hurt us last time, but it's going to be a tough road for a lot of these countries until they reduce, they cut their budgetary cloth to the appropriate measure.
Michael, it's the main reason why I like to have people on my program who've either got no